Well, hello everybody, this is Kim Warren here. Very pleased so many of you have been able to join us this afternoon. It's being English, I've got to start by talking about the weather, and as usual it's raining here. I hope it's nicer where you are. Okay, well, if we're all ready, let's kick off. The idea of putting on this webinar this afternoon really came about because we've spent a lot of time putting out a lot of learning materials about strategy dynamics and putting together classes and slideshows and all that kind of stuff. But it's only going to be valuable and useful to people if they get some sense that this is actually going to be useful in the real world, answering real questions. So that's why we've called it Insights from Strategy Dynamics. And I'm going to talk to you about just a couple of real examples and hopefully demonstrate some of the real world value. I got a question before we started from Peter John asking what we can do as strategists to get strategy back at the core of management, and I guess it's going to be all about telling people that the strategy advice we give them is going to be worth some real money. So with that in mind, let me go on and tell you a little bit about the outline for this session, which I've scheduled for about an hour. But, with luck, I won't actually talk for all that time, and maybe we can have some chat afterwards. Here's what I thought we'd cover this afternoon. First of all, there are just a few folk on the list whose names I don't recognise and organisations I don't recognise, so I need to do a very quick introduction to what strategy dynamics actually is. I hope those of you who are familiar with it already will bear with us while I quickly go through that. I've then got three examples. One, I don't know if you see my blog. If you go to kimwarren.com, there's a blog on there, and we just put up a post on the blog about a piece of work we did on UK satellite TV broadcaster Sky. And I'm going to tell you a little bit about that because that's a rather intensive and interesting rivalry situation. And in the spirit of what this afternoon is about, the better or worse decisions here are worth an awful lot of money to Sky. The second example concerns a recent project that my friend Suresh Mistry at SDS did for the launch of a new medical product. It's actually going to be launching in about 2010, but clearly we need to be getting our act together well before that, so I'll tell you a little bit about that one too. And the third example I was going to talk about is it concerns a situation from my own background, which was extremely valuable at the time, and I see it coming up again. I keep a bit of an eye on what goes on in various retail industries and retail companies, and it concerns a capability. Now that's kind of right at the end of the textbook about strategy dynamics. So I'm putting this in because it is it's one of the more complex and sophisticated ideas in the approach. And the other reason I put it in is I know we've got quite a few people in the audience here from the IT sector, and the story has got a few interesting implications for the IT support in the retail sector, which I hope you'll find useful. I'll end off by talking about the return on investment that comes from using strategy dynamics, and end up altogether with some next steps. I've just had a question, by the way, as to whether the slides will be made available. I can certainly make available a version of the slides. It may not be exactly in this form, but we can make something available for you. The other thing I should say is that we are recording this webinar, and the recording itself will be available as well if you want to pass that on to your friends. So I hope you'll find that useful. So with that, let's make a start. What strategy dynamics tries to do is close the gap that we often find between the strategic planning and financial planning activities that go on inside organizations I keep an eye on things like Harvard Business Review and the McKinsey Quarterly, and this question comes up from time to time. We do seem to have a sense in which strategic planning is a kind of once-a-year party that people have, quite separate from the rather more down-to-earth, people would say, issues of planning the next year's financial forecasts and budgeting and controlling what people do. But in practice, it shouldn't be like that. There really should be a strong tie between those two things. So where's the gap come from? Well, the frameworks we use in strategic planning, I've been teaching this stuff now for nearly 20 years. We've got lots of frameworks from the strategy books, and we pick them up from the journals like Harvard Business Review. And what they do is they take data about the situation we're working in, and they give us the ability to analyze that information and give us some kind of meaning to that. Oh, well, you know, it's really difficult to make money in the airline industry because competitive forces are so tough. Well, that's not untrue and not completely unhelpful, but what's not entirely clear is what that means in terms of what we're going to do on Monday morning. How are we going to do what to make any use of that information? And a lot of that of those analysis frameworks come from a kind of microeconomic analysis basis, and they talk about they address questions such as where to compete in an industry. Now, in practice and in reality, organizations very, very rarely have to answer that question anew. You have to answer it when you're starting up. You may have to answer it when you're facing some crisis and need to reposition yourself. You may need to ask that question if you're considering adding a new type of business activity. But day to day, week to week, month to month, you don't typically get any new insight by forever re-asking the question, where am I competing? So it's not entirely clear what to do. Meanwhile, our friends in the finance function are asking questions about, okay, so what sales are you going to deliver next year, and what profits outcomes are we going to get? And then they use their control systems, be that balanced scorecard or value-based management or whatever, to try and make sure that we keep performance on track with what we promised. The problem, of course, as you can see, is that there's very little connection between the left-hand side and the right-hand side of this picture. And a key starting point for why we did all this in the first place was to close that gap. What we need to know, what management needs to know, is what to do, when and how much to generate what feasible performance outcomes. How do we do that? Well, to start with, we start by asking a somewhat different question than is normally asked. We're not, sorry about that, the slides just skipped on their own there. We're constantly being asked to improve our profitability. You know, can we get return on investment up from 12% to 15%? Well, that's not what investors value. They value performance over time, and they want to know where that performance is going and how we, as people running the business, can improve that performance. And there's a kind of rather simple question you can ask yourself here. Would you rather have a constant $20 million profit each year, or would you like 15 million growing at 50% a year? That's why we're concerned with growth. And if you want to do this strictly correctly, then what you need to be looking at is growth in free cash flows. But that's kind of in the finance field. You can find finance textbooks that can tell you all about exactly why that's the way to look at it. So we're focused on performance over time. How do we usually go about looking at performance over time? Well, we start by doing a market forecast and working out what gains in market share we might be able to achieve. That gives us some forecast for sales, and if we've got some idea of prices, then we can work out what margins might be, and gross margins, that is. Then we try and forecast or set targets for cost savings, and that gives us a profit plan. Unfortunately, most the market forecast itself is not often a very good place to start. The market's development is not an independent variable in most cases. It's determined by the way in which organisations actually behave. The example that I quite frequently use here is the market for 24-hour worldwide television news didn't exist before CNN created it. CNN created it, the market was different than if they hadn't done so. So market forecasts are quite often not a good place to start. In contrast, our resource-driven approach asks ourselves, how many customers will there be, how much will they buy, at what price to give us sales. Customers can be created from some potential pool, and we'll see an example of that shortly. Then we ask the question about what resources that we need on the supply side. What do we need to put in place in terms of capacity, numbers of staff, and so on, and then what does that imply for revenue and costs. So let's look at exactly what that means in practice. When you put that picture together, you end up with these diagrams that we call a strategic architecture, showing how the organisation actually functions. What are the things that are in the organisation? How are they changing through time? And how does that system, working from week to week, month to month, year to year, actually deliver performance? This is an example from the textbook. On the right-hand side, you've got the profits each year being made by the low-fare airline Ryanair, and its profits come from the number of customers it has, people who choose to fly with them. In order to serve those customers, you need staff, aircraft, routes to airports, and the decisions you make, which are highlighted here in green, are all about what to do to change those resource levels. How many staff do we need to hire? How many aircraft do we need to buy? And all that kind of stuff. So the logic of the approach goes, we're focusing on performance over time. That's the question we're trying to find an answer to. That performance depends on levels of resources. Those resources are changed by the rate at which they're won and lost, or added to or removed. And those rates of change may depend on what's already in place. The rate at which we can win new customers depends on how many aircraft we have in this airline, providing the flights that customers want to take. Some decisions, you'll note, are things that directly make a difference to resources. They're directly under management control, like we decide to open a new airline route or not. And others are only indirect. We can't send out a memo saying, I want 50% more customers next week, please. We've got to do other things indirectly to change those flow rates. But the key thing here is that management steers strategy and performance by the decisions that change resource flows. That's how we do it. If the resource flows are zero, the resources don't change, and everything else being equal, performance doesn't change. We just make the same revenue and the same profit forever. Okay, now next point is that we do this all with numbers. This is not a qualitative, directional, arm-waving approach. We actually put the numbers on this thing. So if we want to do this for Ryanair's profits up to today and out to 2011, here on the right we've got the profits of the business. They made 482 million in 2006. They're going to have a tough time this year with all the fuel price and stuff. But a reasonable ambition for them would be to get somewhere near $1 billion in profit by 2011. Knowing Michael O'Leary at Ryanair, he'll probably beat that quite easily, but this is just a plausible forecast. Where does that profit come from? It comes from the company's revenue minus its operating costs. Where does the revenue come from? It comes from fares and ancillary revenues. Where the fare revenues come from? It comes from the number of passenger journeys booked multiplied by the average fare. And the number of passenger journeys booked is the average number of passengers you've got during the year multiplied by how many times they fly. So what we need to know then is how many actual customers do we have, and the number of customers we have is the sum of all those we ever won minus all those we ever lost. So if we want these outcomes in terms of profits, revenues, passenger journeys, the decisions we make in relation to marketing, pricing, route offering, and so on, come from the decisions we make affecting customer choices, joining us, staying with us, buying more or less from us. I see, by the way, that I've just been asked a question about whether I see any value from econometric forecasting for industry demand. I'm sure there is some value from that kind of forecasting, but what I'm trying to say to management here is, yes, there may be some fundamental forces out there that indicate what kinds of changes may take place in levels of demand, but you have the power to make a difference to what you get there. I spent a lot of time in the brewing industry many years ago, many happy years, and it was very well known indeed that the demand levels for beer each year would fluctuate according to changes in customer disposable income. But for any particular company in that industry, any particular chain of pubs or bars, you've got an awful lot of power to change your destiny relative to that underlying forces going on around you. I've been asked also to explain the numbers behind the estimated customers. The beauty of the low-fare airline industry is that companies are extremely explicit about the numbers. Just about every number on this slide is publicly declared, except for the bits on the left-hand side. Now, the company itself would know those numbers, but these numbers are illustrative for the point of view of getting a well-known example that we can work with. I don't know whether Ryanair has 7.4 million customers or whether they had 8.6 or 2.8, but whatever that number is, the number of passenger journeys booked, this number over here, about 34, 35 million in 2006, comes from real people making real decisions to fly with the airline. If there were 7.4 million at the end of 2006, and the average during that year was about 6.9 million, and those people chose to fly about 5 times a year each, then that's the number of passenger journeys. As I say, these numbers are illustrative, indicative of the kinds of things that you should be paying attention to. We'll look at an example with some real exact numbers from the public domain in just a minute. So that's basically how it works. If we want these outcomes, that's what our decisions have got to do. The logic, the process we go through is that if we want to explain how things have got to be where they are, we work from right to left across that diagram. If we want to understand the future and what our decisions are going to do, we have to work from left to right. If we were to do marketing that would win us so many customers, then we could expect so many passenger journeys, so much revenue and so much profit. And that's essentially the strategy dynamics process. Okay. I hope that's been enough of an example for newcomers to this to get us going. So let's get into the examples themselves. The first two have got some very real and substantial financial values against them. The third one is more illustrative. But this one came up. It came up to our attention back in 2004. My friend Suresh Mistry at Strategy Dynamics Solutions spotted this. There's a very powerful satellite TV broadcasting company here in the UK called Sky. I guess they'll be known to quite a lot of folk, even if you're not from the UK. And they make such a great example because it's very clear what's going on with some key numbers here. What this company did, a new chief executive by the name of James Murdoch, son of the nice Mr. Rupert Murdoch, was running the company back in 2004, and they were getting a lot of flack from the city about their share performance and so on. So what they did was they said, well, yeah, just to show how fantastic we are, we can tell you that we're going to hit 10 million subscribers by 2010. Now, here's the situation quite recently, the middle of 2007, after 3 years of effort trying to get towards that 10 million number. as you can see, at that time they had about 8.6 million. Kind of looks as though they're on track there, doesn't it? They started in 03 with 7 million, 8.5 million by June 07. Where might we be by March 2010 or by the end of 2010 to give ourselves just a bit more time to get there? Well, if that's what's happened to the number of subscribers, this is what's happened to the net rate at which they've won new subscribers per quarter. This is simple arithmetic. There's no kind of complicated statistical analysis here. The number you've got each quarter is simply what you had last quarter plus or minus what you won or lost. Many companies, I guess, keep a track of how many customers they win or lose. But here's the background. There are about 25 million households in total, most of which at the time were getting TV services through analog broadcast, terrestrial analog broadcasting. At the time we're looking at here, there are about 14 quarters to go to the end of 2010. They're winning 90,000 a quarter. That's plus 1.26 million, which gets them very close, just short of their target of 10 million. So things look like they're going okay. So what's the problem? Why, in other words, did we think that there was something a bit dodgy here? Well, what this led the company to do was to commit itself to a strategy of hitting that number of 10 million by 2010. How do you do that? Well, first of all, you make sure you give great deals to anyone new who comes along. And what do we mean by great deal? Well, we basically mean cutting the price. We started off by winning subscribers by offering value-added services like Premier Football broadcasts and early release movies, that kind of thing. Well, there's only so many people who want early release movies and who are fans of football. So to keep the engine running, the company was giving great deals. The other thing they were doing was throwing a ton of money at marketing, just hundreds of millions of pounds at marketing. Job done, yeah? Well, it's not quite so simple. Here's the subscriber base, still looking at June 2007, and here is the gross number of new audience wins. So that they've been winning customers at a rate increasing to something like 350,000 a quarter. Now, if they won 350,000 a quarter and the net increase was 90,000, there's only one explanation that makes any sense here, and that is that they lost a load of customers at the same time, about 250,000 of them, as it turns out. Now, the worrying thing, if you just look at the shape of those two charts, is that the one on the right is growing and the one on the left kind of isn't very much. So this raises all kinds of questions about the feasibility of their plans. First of all, can they keep the win rates up? Can they slow down the churn? They've got to do one or other or both of those things if they're going to stand a chance of hitting their 10 million. Underneath those two flow numbers, we've got questions like, well, where do new customers come from? We're winning 350,000. Where are they coming from? Are they coming from cable? Are they coming from analog homes? And how many more are there out there anyway that we might win? Maybe more important still is the next question, which is where do they go? They can't just disappear off the face of the earth. They must go somewhere. Do they go back to using analog only and kind of throw out their digital receivers and chopping down the satellite dish? Well, probably not. It seems that what quite a lot of them do is simply stop subscribing to the value-added services and carry on receiving digital TV through the satellite. The next question is how many people have gone. If you look at the area under the curve on the right-hand side there, I estimate if you go back a little bit before 2003, this company has lost 3 million subscribers in total. Now, that's an awful lot. You've lost 40% odd, 35% of the number that you've currently got. Now, you can't keep doing that. Sooner or later, you just run out of people. Well, maybe it's not quite as bad as that, because maybe some of them come back. Do they ever come back? Why do they come back? And so on. We also need to know where else potential customers go and why. So just step back from all those detailed questions, just look at that basic stock and flow structure at the top there. It is shockingly common how often just that one framework really stumps management. That they simply haven't thought about their business growth in those terms. I've finished a piece of work for a consulting company a little while back. They specialize in HR consulting, and we asked them about their client base, and they could tell us how many clients they have. They could tell us a little bit about how many clients they thought they were winning. They had no clue about clients they'd lost. They simply couldn't answer the question. It might seem odd, but on their customer database, they got all the customers who'd ever kind of in recent history done any business with them. What they didn't know and couldn't actually describe was when has a customer actually stopped being a customer. Did they stop being a customer because we haven't heard from them for the last 3 months, or the last 12 months, or the last 2 years? That one question alone really turned that organisation around from chasing after new customers in a very competitive market, actually going back to customers who, frankly, they'd neglected. So, as I say, just that one simple framework surprisingly often gives a lot of insights. Anyway, that's not what we're about here. We're after another issue with Sky, which is the competitive issue. So here's Rivalry 101. Okay, this is class 1 in Rivalry Dynamics, and it's about competing for potential customers. And the way it works is there's a potential customer base out there who might come to us, or they might come to our competitors. There's a limited potential of people who could join us or our competitors. So who are the competitors, who's winning and losing, at what rate, and what's this doing to the remaining potential? Because in this case, that's going to determine whether we stand any chance ever of hitting the 10 million target. Well, here's the situation. As I say, about 25 million households in total, 10 odd million were still using analog TV. Sky had about 7.4 million. Sorry, I should have said, by the way, I'm now looking at the situation in 2004 when we first did this analysis, so it's a little earlier than the point in time on the previous chart. So back in 2004, 10.2 million still using analog TV. Sky had about 7.4, still even then winning less than 100,000 a quarter. Cable companies had about 3.7 million. But the killer here is that already at that time, there was a new service launched into this market called Freeview. Now, Freeview is a terrestrially broadcast digital TV service. It provides about 30 channels. A lot of the things it doesn't provide are the premium things like the Premier League football and the recent movies. But quite a lot of choice and plenty for many people. Loads of kids channels, for example. So if you're a family with kids, there's plenty on Freeview for them. And look at the rate that was growing, 400,000 a quarter. Now, you don't have to capture 400,000 per quarter for many quarters to make a serious dent in the 10 million that are left up there. And that's not the end of Sky's challenges, because then the next thing coming along is FreeSat, which is the ability to receive digital TV through free satellite services, and that actually includes people who lapse from being subscribers to Sky. So, since Sky's real USP was only for sports and movie channels, and most of those fans were already won. That's an important point. At that point in time, 2004, most people who might want those things were already captured. You can't capture the same people again and again and again. So the fraction of those remaining homes, the 10.2 million, is certain to keep dropping sharply. My auntie is not a keen Manchester United fan, nor does she want to see the latest Batman movie as soon as it passes out from the movie theatres. So the chances of her signing up for Sky are, frankly, 0 or pretty close to 0. So there's the challenge. Right, what I'll just do, let me just switch over now to our little simulation package. For those of you not come across it, it's called My Strategy, and it's a very simple simulation package that allows you to run the kinds of numbers that I've just been talking about on that last slide. In fact, why don't I just show you the result of this before I go and run it. This is one scenario for the future of that situation we described. Here's the data at the end of 2004, the numbers I told you about. There's the 7 odd million Sky homes over there at the end of 2004. And the colour code here is that sky blue is Sky, and blue things are good for Sky. So here's the fraction of these homes here who, from 2005 through to 2010, that's the fraction going out to Sky. This is the fraction going to Freeview. This is the fraction going to cable, although there's a bit of backflow as well. And we've got this FreeSat category down here. So what's happening here? Well, Sky keeps on winning a nice big fraction of these analog homes. Freeview also captures a nice big fraction of those homes. You see, quite conservatively, we're assuming that that's going to tail off, even for Freeview, as the analog homes population falls away. But here's the killer. This is the churn rate of people giving up on Sky. So, and you can see in this particular scenario, they end up well short of their 10 million. I think about 9 million, in fact, people with ending up subscribing to Sky. So let me switch back to the simulation, and I can show you how this works. We've got the various parameters here on the model. These are just variables in the model that control the flow rates from one place to another. So this one here is the flow rate from analog homes to digital to cable homes. This one here is the 5% each quarter going from analog to Freeview. So if I run a scenario here, let's run that out to 2000. That's the end of 2004, the point at which we did the analysis, and my friend Suresh wrote to the Financial Times and casting doubts on Sky's forecasts. And with those assumptions, then there's the outcome for Sky subscribers, and they're getting up to somewhere around the 9 million subscriber level, which is on the slide I just showed you. What do they have to do much better than that? Well, let's just play one scenario here where the fraction of the future fraction of Sky subscribers who are lost, instead of being 2% a quarter, let's make that 0.15 or let's be even more generous and say 0.1 here. And let's run that with that new fraction. So how would they do if they could get the churn fraction down to less than 1? Yes, they'd hit their 10 million if we could do that. But that's an annual churn rate of only 4% and a bit, which is pretty unprecedented in this kind of market. It looks really, really rather unlikely. So that's a scenario that might give you the target you're after. So I see, by the way, I've been asked another question over here, my friend John Capson at Sun. Did I derive these conversion fractions from historical data? Yeah, so the question is, where did these fraction numbers come from, the 5%? Well, if you look at the rates at which these numbers are growing, they are about consistent with these kinds of win rate fractions. In fact, this 5% is a bit generous to Sky. It's a bit more like 4 or 3.5%. So what we're doing is we're projecting forward the ability of these services to continue winning the same fraction of what's available, this analog homes pool. As always here, I'd just like to emphasize this point at the bottom here. As always, the outcomes depend on the flow rates. Strategy is all about the flow rates. And there is no realistic set of assumptions that get Sky to 10 million subscribers by 2010, which I'm pleased to say they put their hands up to in a recent announcement. So good to know that back in 2004, Suresh and I were able to foresee that this wasn't going to be possible. By the way, if you're interested, this model is available on the strategydynamics.com forum website. Go to that forum and select the knowledge exchange category, and there's a business category inside that where you'll find this model available. I'm a bit conscious of time. I'm going to need to press on here. So what would a better strategy for Sky be? Well, drop the symbolic ego target. No, just bear in mind, no one ever asked them to promise that 10 million. So why did they do it? Why give yourself a tiger on your back that you can't get rid of? They sort of focused on quality, not quantity of subscribers, people who pay them good subscription rates. Focus on retention, not acquisition. The result would have been much less spending, much less discounting, and a whole shedload more profit than they've actually delivered. So there's example one. Let's go on to example two. This concerns a medical product launch of a product replacing another product that was going off patent. I've got to be a bit careful about this particular example because it's a highly competitive situation, and there are some kind of legal issues inside it as well, so I can't say too much about it. But this is the situation. The medical product is something used by people who are susceptible to a particular kind of condition. The condition can be pretty serious. It can be life-threatening. It's estimated in the UK that something like 400,000 people suffer from this condition, but most of them don't actually know it. They only find out when something unfortunate happens. When it happens, what they need is they need constant access to this medical device in case the emergency arises again. The problem is this: the existing product is going off patent in 2010, and that is going to result in the total loss of this company's sales. This is not, I'm going to lose 10% or I'm going to lose 15%. I'm going to lose everything here. The company has got a new product with some, not major, but some additional product benefits. And because of the legal situation, it cannot share the same brand name as the product it's going to replace. And it's going to have to launch that product and replace the old one very, very fast indeed to catch that loss of sales in 2010. And again, for competitive reasons, it can't actually start doing anything about any of this until 12 months before the loss is going to occur. So what do we want to have happen here? Well, here's the framework. On the left, you've got something like 300,000. We don't know exactly, but something like 300,000 people who remain susceptible to this condition but don't know it. We've got about 100,000 who are using the old product. And where does sales come from here? Well, you get sales from two things. The first sale you get is when someone discovers they've got this complaint for the first time. If they're lucky, it's mild, and they go to their doctor, and the doctor says, yes, you've got this complaint and you need this device, here it is, or you go to the pharmacy and get it. The product actually wears out after a while, so if you're going to keep on top of this, you need to replace it. So the second source of sales is replacement sales. Now this gives the company an opportunity to gradually build sales by switching patients who know they've got this complaint from the old product. You can see the 100,000 odd people down there using the old product, and if the company could just pump them through up here, they would get sales from this flow rate and from patients using the new product. So how do we put this this problem together and work out what to do? The key here is to get all new events, these events when people discover for the first time that they've got this condition. We want to get those events onto the new product instead of the old one very quickly. Plus get that existing custom patient base switched across from the older product to the new. Once people have kind of got this product, they basically replenish it or replace it by just going onto the pharmacy and asking for it. So if you're going to get that second flow running, you've got to market directly to those people. Here's that same framework down in the bottom right. Now, what has to happen for that to work? Well, people get put onto this product by doctors. Sometimes local doctors, sometimes if it's an emergency and you get blue lighted off to hospital, it's an emergency and you get it in hospital, but local doctors give people their first access to this product quite often. Down at the left of that particular pipeline, there's about 10,000 doctors currently very happy with recommending the old product. We've got to make them aware of the new one, and then we've got to get them committed to the new product. And it's this flow rate here that's absolutely crucial. That's the flow rate we've got to drive. We've got to move doctors from bottom left to top right. How does that happen? Well, doctors respond to recommendations from the experts in this particular field. You know, being a general practitioner, you don't know all about everything, so you tend to listen to what the real experts say. And there's about 20 odd experts in this particular complaint, real top experts. They're the people who write the articles in the medical journals and so on. So it's their recommendations there that persuade doctors to change their behaviour, if indeed they're going to do that. So here are the things we do. We spend marketing money to make patients aware and hopefully switch. We spend marketing money to make doctors aware. We spend sales effort on persuading key opinion leaders to change and on persuading doctors to change. But anyone who's been in the pharmaceutical industry knows how very tough that link is there. You know, it's tough enough even getting to see the doctor, let alone persuading them to change their mind about what they recommend to their patients. So those are the questions we had to answer. So this company knows quite a bit about this market. We didn't need to do a whole load of market research. There is no point here doing a market forecasting step. The market will be whatever it is according to how well we turn into reality the potential customer base. So finding one is that the marketing we thought we were doing to persuade customers really cannot be effective. It's a very diffuse complaint. There are very few people actually got it, and it's simply not economical in any way to communicate with those people. The only way you can do it is really through some kind of patient community website, which is already in place. But that basically means that flow rate is going to be slow. Finding two is that there's no plausible rate of recommendations that is going to drive doctors to change their behaviour anywhere like the rate we need it to happen. You know, doctors, okay, they read the journals, but they don't constantly worry about what they're going to do about this particular complaint. As I say, it's pretty rare, so you know, it's not top of mind, as it were. Finding three is that, you know, as this company has known for a long time, sales effort really can't persuade doctors to switch fast enough either. Now, so we're on the hunt for something else here that we could use to really ramp up the rate of change. And what we found was that every now and again, doctors go on training events. They tend to be kind of multi-topic training events. They go away for a day. One of the doctors in a practice will go to one of these events and they'll hear about heart disease, or they'll hear about diabetes, or they'll hear about whatever it is from experts. And what we can do is that we can get to the key opinion leaders, and we can get the key opinion leaders a program of training events for the doctors to advise the doctors of the benefits and get them to switch. Now, we've got 20 key opinion leaders. Here is the maximum rate of training events that can be run, a maximum of 1 per month per KOL. So that's the maximum rate of training events. That gives you a maximum rate of doctor switching, which gives you the maximum growth rate in the number of doctors committed to the new product. That sets the constraint on this flow rate here, which is how quickly new patients will switch from the susceptible pool when they have this event onto the new product. What are the findings here? Well, here they go. Irrespective of Salesforce investment, loss of the old product will just happen, and we'll lose 25 million euros in turnover. Specialist awareness and inertia have got to be overcome quickly. New product benefits have got to be disseminated in training centres. Here's the big one. Once you've got that training happening, then it makes sense to have the sales force call on the doctors. And this sales force is 10 times the sales force that's currently deployed supporting this product. It's not 50% more or 15% sales cost relative to revenue. It's 10 times the current sales force effort. That can move things fast enough. And after that blitz has happened, then the patient flows on the diagram become the rate limiting constraint. So by 2015, for example, you'll still have 40% of patients still back on the old product. I have to say, by the way, we made some pretty conservative assumptions. I think the company can actually do rather better than this. But in total, when we worked all this out, we're looking at massively greater cost in driving this new product than this company had ever conceived of before. This was a very, very big number for the board of this company to consider. We're not talking about GlaxoSmithKline here or one of the other big, real huge companies. We're talking about a mid-sized medical product company. But this is the kind of difference it can make. That's the sales forecast we could have expected with the previously planned strategy. That's the sales force we can expect to get. The sales outcome we can expect to get if we do this properly and deal with it correctly. And that's the difference it makes to operating profit. We don't just recover the profits we were making, we get back above where we were before. Because the educational thing actually does such a good job of getting people recommending these devices to people who need them. So, still being conscious of time, let me just race on here. Example 3. This concerns the issue of capabilities. I don't often talk about these in seminars, but capabilities are becoming increasingly recognized to be important. So if we're trying to build some resource, what do we want to be good at doing? A capability is what we're good at doing. When we want to build a resource, what do we want? We want it to be built quickly. We want to win customers, we want to hire staff, we want to launch products, we want to get capacity on stream quickly. So quickly is the first thing we want. The second thing we want is we want quality. We want good customers, not bad ones. We want skilled staff, not unskilled ones. We want products launched with good customer appeal, and we want this new capacity to be reliable and powerful. And the third thing we want is that we want this at low cost. We want to win those customers with limited marketing costs. We want to hire staff cheaply. We want to develop products at low cost, and we want to build capacity without spending too much on it. So just bear those 3 things in mind, because that's going to become the key in the example I'll give you here. And the example concerns opening retail stores. I spent a lot of time in my professional career in pub and restaurant retailing worrying about this issue, and we had fantastic people at this particular task. People like Starbucks and Tesco and Walmart and so on. They need really good people at this, so this needs to be a strong capability in those organizations. What exactly do we mean about these detailed capabilities? Well, these people who find stores, we want them to get those stores open quickly. Now, what's the success factor here? It's the lead time in quarters. Can we open it in 3 quarters or 4 quarters or 5 quarters? So what's the capability indicator here? It's how quickly do we actually open a store relative to the shortest time we could possibly open it if everything went right. finding good locations. As the old saying in retail, it's all about location, 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 and locations determine the fraction of the potential customers in an area you can reach. If you find a good store, you can get nearly every potential customer. If you found a bad store, with not enough pedestrian traffic walking past your door or whatever it may be, you're not going to get all of the potential that you would otherwise have had, and maybe your competitors are going to take those customers from you. And the last thing you want is you don't want this to be too expensive. If this store site, if really good negotiating, would be able to get this store opened and developed for $1 million, but you're not very good at it, and it's going to cost you $1.25 million, then your cost capability on this is not good. So let's see how much difference this makes to a retailer. These things are of critical competitive importance. If your capability on opening stores quickly is so poor, it takes you 6 quarters rather than 3, what does this mean? It means you start trading 9 months later than you otherwise could. That's a lot of money for a retailer. If you're not as good at finding good locations, that means the store is going to take 30% less in revenue than it otherwise would if you'd been good at this. And if your cost capability on this is not good, this means you can only open 8 stores for a certain amount of money when your better competitor could open 10 stores with the same cash. So these are not abstract or ambiguous concepts. They're very clearly definable and measurable, and we can track them and monitor them and keep them under control. How much difference does capability make to performance? Well, let's have a look at that on this store opening. Now, here's a great new retail concept needing 250 stores to reach its full potential. And if we're pretty good, we decide to open stores. You'll see there's a time lag between when stores are open. This is the decision being taken to open a store, and this is when we actually get it, and there's a little delay here. How long is that delay? We'd like to open stores at that rate. With a strong store opening capability, that's what we get. And what that does, opening those stores, gives us access to potential consumers. We've still got to turn those potential consumers into real customers by offering appeal and value and products and serving them well and all those good things. But that if that goes well and we're good at this appeal and value stuff, that's how quickly we can drive consumers. Now, we think that there's 3 million or so active consumers in this market. Now, what happens if we're not that good? And obviously that makes a big difference to the sales rate. Well, here's the difference it makes. If we're bad at lead time, we open stores slower. If it costs us more, we spend money slower, but we end up spending more. So we end up spending more money to get fewer stores later than if we were good at this. If we're not very good at finding good store locations, what that does is it slows down our ability to get at potential consumers, which means that our active consumers are way, way less than they would have been because we're slower and because we're not so good at finding good sites, which does a big, big damage to the sales rate that we managed to achieve. And all of that has a devastating effect on the profitability that comes out of here. So kind of maybe now we get a sense of just one of the mechanisms by which people like Walmart and Starbucks and so on are so very, very powerful at what they do. This is just one of the things that they're very, very good at indeed. Now, I mentioned that there are, at the beginning, there are some IT implications behind all this. And when I was involved in this and the conversations I've had since with people in the sector, one of the key things you need to be good at this is you need really good IT systems to quickly appraise sites, to do the demographic appraisal of those sites. You need knowledge bases about what a good site looks like and all that kind of stuff. Certainly when I was involved in this, the IT services we had were pretty crucial to doing this well. So, what about the ROI from strategy dynamics? Now, first of all, I should say neither of the first two examples I talked about actually took very long. The Sky analysis took us about 3 days. The the medical product, the total project lasted 2 weeks from start to end, including the Christmas and New Year break. We were lucky that particular organisation knew its stuff pretty well, but both of these are worth huge amounts of money. And I'd also suggest to you that I can't see of any way at all, that those challenges could have been solved any other way. You just can't do this with spreadsheets. The spreadsheets hide all these kinds of assumptions that are going on, this is the way to answer these questions. Example 3 is high ROI as well. As I said, having a high capability, in this case on real estate site acquisition or merchandising or whatever else it is you've got to be good at in retailing, makes a big difference. As I said, that particular example was powerfully supported by IT systems. The last point I'd like to make here is that the difference between good and not so good strategy is massive. We're not talking here about kind of just a little bit of difference. We're not talking about kind of making 20% more profits or 30% more profits. We're talking about the difference between huge profits and huge losses, or getting that medical product back up to profitability inside 3 years versus never. So these answers are worth an awful lot of money, and it's worth doing the work properly and professionally to get it right. Let me just end with just a brief comment on IT investments, because I know we've got quite a few folk from the IT world online here today. One, it's quite difficult to make the case for IT investments, as I'm sure you're all pretty well aware. And the reason for that is that it's got to work all the way through this very complicated system to eventually come out in business performance. I said a little bit about this I think in chapter 9 or 10 of the textbook, but in very summary terms, here's what's going on. It's the architecture of resources that drives revenues, costs, and profits. If IT information systems are going to help here, they have got to work on that resource change rate here. They've got to allow the organization to do things faster, better, cheaper. Now, the kinds of things that IT can help with are staff skills, data quality, the effectiveness of the systems themselves, and the business processes that sit around that. So when you're making decisions or trying to make the case for investments in IT, you're way back here over on the left-hand side. And that's complicated still further by the fact that you're not talking about just one initiative at a time. You've usually got a portfolio of IT-based investments that are being made, which have differential effects on all of those 4 categories of IT-related resources. And eventually, if you're lucky, it all comes through and improves profit. We're kind of out of time for saying much more about that today. But there's a little bit more about it in the book, and if anyone's interested, I guess I could look at putting on an IT-specific webinar on this. Okay, so there we go. I hope you found that useful and interesting. I see my time is up. We've come to 5 o'clock, so let me just end by suggesting some next steps that you might like to have a look at. There are several options to learn more about strategy dynamics. So this is going to be by way of a little commercial. I hope you'll forgive me for that. First of those is if you go into strategydynamics.com, you'll find there various presentations and stuff there that you can look at for free. Secondly, we started a briefing series. It's basically a fortnightly email. I try to keep them quite short, and it basically each email kind of summarizes a little nugget from the book. Just sign up for that, and you'll get an automatic stream of emails. As I say, quite short, only fortnightly, but each one I hope you'll find is pretty valuable. The next option you have is to register on the Strategy Dynamics website for access to the worksheet materials. Again, that's free too. Oh, yeah, there's an awful lot of free stuff here. So if you want to go one step further still, please feel free to buy the book. You'll find it on Amazon. I'm sure there are various deals you can get on Amazon depending on where in the world you actually are. And the last option is that we're now offering the course that goes with this book online. You can take it completely on your own and just run through the materials. There's about 15 hours of video presentations and a whole load of exercises for you to work through. I will do my best to kind of look at the chat system that goes with that course and do my best to answer any questions that come up. If you'd like the kind of more extensive version of the course, then I'll actually give you support on applying all the frameworks all through the course to your own issues, and you'll find that at the strategydynamics.com/mastering URL. I think it's just a little note there about our shop being in GB pants, so that's just a little thing about the exchange rates. Okay, so that about wraps it up for this afternoon. I've got another question over here that I see on the chat. It's from Peter again, saying, what about the non-financial factors that constrain strategy, such as the outside environment? How can these be integrated in strategic decisions? Well, of course there are constraints from the outside world, and yes, we do have to take them into account. In fact, we've actually been talking about them. You know, the Sky example is constrained by the fact that there are only 25 million homes out there. The medical product market is constrained by how many people are potentially susceptible to that particular complaint. It's also constrained by I think I mentioned there's a kind of rate limiting factor going on here, which is just how quickly it is possible to actually get customers to change their behaviour. There's much more to be said, of course, about those constraints from the outside world, the technological constraints, and as well as competitive ones and so on. But if you have a look at the frameworks in the book, you'll see that there's quite a bit there that at least implicitly addresses external constraints. And if we go right back to the very first one we talked about, Ryanair, I think we're going to see a bit of a bloodbath in the airline industry over the next 2-3 years as weaker rivals than that particular company find that those external constraints are really going to become way too tough. You know, they're going to be hit by environmental limitations. They're going to be hit by shortages and price hikes in fuel prices and so on. So yes, thanks Peter for bringing that up. We do have to take account of those external constraints, and indeed we do so. So I hope that's been useful to everyone this afternoon. Thanks for your attention, and we'll do our best to get this recording up and available as soon as we can. And I very much hope to hear from you again soon. So bye for now from not quite so rainy England.